across a number of the initiatives that we're involved with that are being built on Corda. And that's really because it's either people want to be able to sweat an asset or release capital or raise capital because they are witnessing either extreme downturns in their revenues and their growth or extreme acceleration in revenue growth. So one of the unintended consequences or inadvertent effects of COVID is it has created these incredible extremes. So I'd certainly say in the world of capital formation and raising of capital, we've definitely seen a massive increase in appetite. And that's not just within sort of the larger corporates. It's also within the smaller industries and the micro sort of economic areas as well, the really sort of small entrepreneurial sectors as well. So definitely changes there. And I'd also say we're seeing some big changes in transformations, not just in areas like post-trade, but also in other parts of the existing life cycle to try and drive much greater efficiency, much greater transparency, because people recognize which we're going to be facing a lot of challenges going forward, and we have to be much more efficient. We have to be much more transparent. And we're seeing that a lot of the life cycles that live there today, the legacy life cycles, and how we can leverage the ledger and the digital representation of assets, existing assets, to drive much greater efficiency. And post-trade is a really good example of that. And I'd say the other thing is that people are looking at how they manage things like cash and collateral, because against the backdrop of the increasing obligations for collateral like UMR, we have to be much more efficient about how we manage our cash and our collateral. And again, the mobilization through the use of asset digitization, cash representation of cash in a tokenized form or collateral in a tokenized form, and this ability to mobilize it with much greater cadence, moving cash and collateral, almost instantaneously, which of course we couldn't do in the past, is again really important to optimizing the assets we have and making them as powerful as we can possibly make them. So I think it's having some really diverse but very positive impacts on the adoption of tokenized assets and DLT industry-wide, which is very promising actually.
Yes, indeed. I think, with private companies, you're now seeing the extremes, as you say, right? I mean, this terrible crisis, I think, there are private companies that have been put under test that maybe might not make it through the crisis, but there are many that either have been profitable, grown organically for many years, find themselves needing financing through no fault of their own, great, strong companies. And you see the companies, as you say, they're really taking off, that their markets are really growing exponentially as a byproduct of what's going on at the moment. In all these cases, they're all looking, many are looking for financing or in different ways. And many of them also probably looking for lawyers as well, right? After that, how's things with you guys right now at Chess?
It's quite interesting actually, Anthony, because there was, after the initial lockdown phase, I would say there was a slight slowdown in communication by sort of projects that were sort of kicking off, but actually it's come really full steam ahead. I mean, we've seen it both on the institutional side and the startup side, actually. Clients like Goldman Sachs announcing that there's a new head of blockchain, and that's during this lockdown period. So that shows the institutional support. We've just been instructed recently by a very significant group on the development of two cryptocurrency projects, which I think when they come live are going to have a serious impact in the market. So that's on the institutional side. And in terms of the startup world, we opened the FinTech Legal Labs formally for applications 2 weeks ago. When you're an advisor on that lab from your SG days and continue to be. And amazingly, we've had close to 65 applications in a 2-week period. And that shows you that there is still, and a lot of those applicants are very high quality and are actually active in this space. Not all of them, because it's not purely a blockchain-based accelerator, but there's a big component of that. So I think that there is still momentum. There's still a lot of interest. People are recognizing that they want to have access to their assets and currencies in digital form more than they did. I just don't see a slowdown in it. Whether we're going to see digital assets sort of be accepted more broadly, I can't give you a timeline on that. That could be very quickly, or it could just take some time, but it's no doubt going to happen.
Yeah, indeed. I think the this whole excitement, this world. The word's getting out a little bit more broadly. I think we had Jay Clayton, the chair of the SEC, commenting last week. He's realised, he's thinking maybe all stocks might become tokenized over time. Which, it's quite a revelation. But what I say, I joke slightly, but does this for you guys, senior executives, C-suite, this sort of thing, is that awareness there as well? Do you think that the organisations are waking up to this?
So I would say pockets are, and pockets are still sort of learning. There's no doubt that the governments and regulators are very aware of it. I mean, you probably saw there was recently, 24th of September, the EU sort of came out with its digital finance strategy and proposed laws around that, including, a market in crypto assets, right? So regulators are aware of it, and they are, because there's a lot of institutions, submitting proposals and saying, look, we need these changes in law to be able to accommodate such things. And we're going to have new asset classes that are going to come out other than the traditional. But I actually agree with that observation that we're going towards this path of tokenization, as a term, could be called something else, but that is the path we're going down. There's no doubt about it. Everyone in the market that I speak to is generally aware of it or learning about it.
And Emmanuel, I know you worked this out about 6 years ago, right? I remember us having conversations back in 2015. But what about the senior executives at Credit Suisse? Is that message getting through?
I wouldn't just speak about them. I think I spend a lot of time with our big clients as well, and I think to Abradad's point, that they're still learning, and I think people have to figure out what do we mean by digital asset in the first place? What do we mean by tokenization? For many of us, I think they look at the world we live in today, which is electronic, and they confuse electronic with digital. They confuse book entry with digital, and they say, well, what's the difference? And I think sometimes you have to go back to basics. You have to go back to where we are and how do we get here. And I kind of tend to look at this as the part in the kind of the three tranches of the past, the present, and the future. And you have to evoke kind of the imagery of what would it have been like to facilitate trading in the pre-electronic, i.e. pre-compute. You have to go back very far. You have to go back prior to 1993. In fact, why don't we go and think about what it was like on Wall Street or on or down in the City of London, and how were trades actually facilitated then. And some of us I'm not old enough to remember that, by the way. I got it here just at the advent when desktop compute was coming in. But some people on the call listening in might remember that, right? In terms of bikes and couriers and signatures and all that good stuff. And so it's not all that long ago that was the way that we did things. It was slow, it was expensive, there were lots of mistakes. And then we get to the point in the, I would say, mid to late 90s, certainly the mid 90s, when desktop compute, if we think about the first wave of internet, which is about connectedness, is late 90s and certainly early 2000s. So again, not that long ago in the big scheme of things. And when we look at our infrastructure, this is when we become electronic, this is when we become book entry. This is the phase we're in now. And so one of my very first roles when I started on the street was in a company called DLJ, which you might remember was bought by Credit Suisse. And we wrote systems at the time that did trade entry. And so that means we wrote a system that automated the 7 steps that the trader was cared about. He was off of a paper blotter, and he'd heard about this thing called desktop compute, and he hired a smart Englishman called Emmanuel Adi to go and create a trade entry system for him. And then the middle office person, maybe someone like Angie, hired their own person to do the next few steps in that process. And maybe the finance control person, the product control person, hired an IT person to automate the P&L process. And then pretty much 20 years later, you end up with 3,000 systems across 8 different products, all connected via either messaging protocols or FTP files or how we're sending messages. And that's the mess we're in today. We're reconciling across systems where logic has been applied and interpreted in different ways. And that's what we're trying to unbundle with a digital asset. And the digital asset is an asset where we've got a single understanding of the term sheet and a single understanding of, how the rules, the regulatory rules applied to that term sheet in terms of its accounting standard or its transfer rights, etc. And we believe fundamentally, everyone on this call, as I know, that what we saw happen when we went electronic, which is that it became much more efficient, and we went from some price to zero to transfer security, and the volume went up massively. That's the benefit of electronic. But we stalled at 2 days. Now what will happen in this scenario is we're going to get to instant, we're going to get to 24/7, and the cost of compliance, the cost of regulation, and the operational risk associated with everything we built over the last few years is going to disappear. That message, to your point, took me a long way to get there, but that message I don't think has completely sunk in and resonated with every senior executive in a leadership position across not just my firm but others. Because if they did, then digital assets wouldn't be something that was scary, unknown. It would be just the next iteration of securities. And I'm not saying that there aren't opportunities to develop new parts of the cap structure that we haven't thought about yet using virtual cryptocurrency parlance, but there's enough wood to chop, simplifying the internal banking stack using digital assets, that we can focus on that. Chewed up quite a bit of your time there, but hopefully that was useful.
No, I think it's really important to have that historical context and think about the bigger picture, because I think sometimes you've got either people who have just been in this world of transformation the last few years, and think everything's changing tremendously fast and don't have the awareness of the world that was. You've got those of us that maybe had been through tremendous transformation in capital markets and financial services industry maybe 20 years ago. I mean, I remember when looking at a trade floor, rows of spot traders individually hedging Eurodollar spot trades, and we implemented a system at a big American bank. I won't mention here, well, it was a fantastic program, FX Auto Trader, right? And it did what it said on the tin. I think by the time we finished the project, you had far fewer spot traders and someone managing currency inventory, flattening their inventory in real time. And I think it's that balance of living through change. And then you've got lots of people in the financial service industry that think things aren't changing because they wake up tomorrow things it did today. It's like looking at the minute hand of the clock. Plus, as you say, we're sitting on 30 years of tech legacy in that space. But I think, the transformation that we saw in capital markets 20 years ago, we think of wholesale banking more broadly, not just in terms of the public secondary markets, but what is going in the primary markets, both on the private side and then the IPOs that aren't happening so much now on the public side. You start to see the opportunity for the whole life cycle of those financial products, those securities, right? Not just that public secondary trading, which we will think about when we think about technology in this industry. I don't know if you had anything to add to that, Angie. I know you've obviously haven't lived through quite as much of this, I'm sure, over the years, but I joke. But no, I mean, for yourself, you came through a FMI background. I mean, what's your perspective on those transformations?
Yeah, I actually came, most of my life I spent on the equities trading OMS side. So it's really interesting to hear Emmanuel's story, because I came from the period when we went from blotters and writing orders on blotters and handing them to sales traders and all of that being very manual to, as electronically executing baskets of 3,000 orders in less than 5 seconds or 2 seconds, or eventually sub 1 second, and obviously doing things like low latency trading in microseconds. So I've seen the whole gambit from beginning to end, only in the front and middle office. I think the Jay Clayton thing is really interesting. I think it represents a really quite a significant change in sentiment. I don't want to speak out of turn, but I've witnessed in the last probably 9 months a really different attitude amongst the national authorities within the various jurisdictions. You've seen some really big changes. I'm sure Abadat could tell you in much better detail than I can, but they represent a sentiment change across the regulators. And the problem is within our industry, the reality is, and particularly amongst the FMIs where I spend a large proportion of my time today, they're very highly regulated. They by their very nature, they are, quite rightly so, deeply conservative, very risk averse. And without the regulators embracing the use of tokenization and digital representation of assets, and without them embracing or at least acknowledging the use of the ledger for institutions, the FMIs were never really going to sort of go on the journey with any great scale until the regulators were actually sort of giving them the so-called thumbs up. Now, what is interesting is in that European Commission's strategy, one of the 4 main priorities, which I was absolutely delighted to see, was that they want to see the regulators and the regulatory frameworks in which we all live and exist every single day to become much more embracing of the use of DLT. And I was very pleased to see that, because as you well know, the regulators won't mandate the use of technologies. That's not what they're there to do, and they're very open about that. But without them actually recognizing the use of asset digitization and tokenization and the use of the ledger, it was very difficult, even for the most innovative of exchange groups and CSDs and CCPs and market infrastructure providers, to really drive innovation. Now, I've seen a big change. I don't know what everybody else feels in this group, but in the last 6 months, we've seen some of the coldest of regulators really start to feel much more motivated and collaborative around the use of digitization, tokenization of assets, and the use of the ledger. And that's really good news for everybody in our industry. We're seeing some very radical transformations now in the way that we're using tokenization to do things like fractionalize very large in scale, esoteric assets such as real estate and infrastructure, and even things as wacky and lot out there as fine art, racehorses, football players, you name it, they're doing it. I mean, anything that's got a value that can be shared across a broader audience in a digital form makes it available to a much wider community. And the fractionalization creates democratization, as you know, and that's really good news, because then we're opening the door to much broader communities of investors institutionally. I haven't even gone beyond that. So that's a very important element. And the use of the ledger to share that data, a single version of the truth, in the same way that we do with limit orders. Lit markets are all about a single version of the truth. We're looking at the order book, we're looking at those market orders that we should be able to execute against. And so the ledger does the same thing, is it provides a single version of the truth in relation to an asset and an asset's life cycle, which is fantastic news for the market, because it broadens the accessibility to those assets, either in their raw form or in their fractionalized form. But it also means that we all look at one version of the truth. And if ever that was needed, and Emmanuel again alluded to that with this incredible complexity around the market structures and around the infrastructure that we run individually, by having a single version of the truth across a whole market, across a whole asset class, and a whole group of people who are working together within that group asset class, will make for vast simplification and reconciliation. Could well be eventually a thing of the past, because the more of those life cycles that are condensed onto the ledger, the less the use for reconciliation will ever exist in many of these life cycles, because you can't reconcile something that everybody's looking at if it's the same thing. So one version of the truth, one immutable record, one trusted ledger, which is immutable and secure and has complete privacy, and we can do some very transformational things. And we now seem to have the regulators really starting to come on side and recognizing the benefits of that. So I'm very happy with all of that, and the sentiment and the change over the last few months.
Yeah, I think you have to work within large institutions, or have done, to have seen hundreds of operations staff doing a reconciliation, dealing with breaks and fails and all of that complexity that goes with it. You referenced alternative asset classes a moment ago. It's interesting because you're focused on capital markets. I think historically that's been shorthand for public capital markets, but actually you hear people saying that more now, because there's an understanding that we're opening up the private capital markets as well. And I guess you're looking across that whole spectrum. So where do you see it having the biggest impact, or how do you see that proceeding in terms of transformation of traditional, say, securities, equity and debt in the public markets versus maybe equity and debt alternative assets. I mean, how do you see, where do you see that playing out with the biggest impact over time, Angie?
So I think I think in terms of the equity markets, I think there's going to be a big impact, particularly in the small cap and the micros and the private equity marketplace. I think the use of the representation of those assets in a digital form, the fractionalization of them in itself could bring greater liquidity. So if you think about the small cap markets where we really struggle with liquidity, I mean, I come from an equities world, and within those small cap markets and the micro markets, it's very difficult to create liquidity. By fractionalizing, that in itself creates greater liquidity because you're moving much smaller units. I think within private equity, there is an increased demand for more favorable and more diverse ways of raising capital, and the use of, again, tokenization of and digital representation of private equities, and making those assets available to be invested in by a much broader community, which the ledger allows us to do within a very secure.
Could I jump for one quick second? Sorry. You mentioned something, Angie, that I want to just ask a question, and maybe to Abradat on this, which is, I haven't yet been convinced that just because you fractionalize something, because the asset itself has got to be something people actually want, and that want drives the liquidity. And the second thing is, and this is the Abradat part, have the regulators had any opinion that, you know, an asset that today is, you know, institutional only because it's illiquid, let's say it's a PE fund, or it's something that's a Reg D, for instance, that's labeled that way. Just because it's fractional, does it mean that we can sell it to retail?
So both those questions aimed at me, right?
Yeah.
Okay. Emmanuel, so I agree with you. For something that's just fractionalized to actually be taken up, there needs to be a market on it. And a lot of these projects that we get approached on let's look at fractionalizing something. When you actually start digging into it, there's a lot of legal challenges and commercial challenges, right? So for example, let's say it's a hard asset, and you know, you fractionalize it and you sell it to a group of investors, and there's something that asset requires an investment. For example, an insurance event, or the asset gets damaged. So you need to go out to all that market of holders and say, well, who's going to pay for it? And what happens if, say, 90% pay and 10% doesn't, right? How do we deal with that? So there's all these conversations. Let's fractionalize art. Let's do these things. Okay, well, so if you fractionalize art as an investment, you know, where is it going to sit? Who's going to actually enjoy it, right? There's a lot of these kind of conversations going on. And when you actually dig into the detail, the actual legal infrastructure around it hasn't been, and commercial, it's not just legal, because we basically hear what you have to say, what you want to do, and build it. It hasn't actually been developed yet. I'm not saying it won't. I think there's a massive opportunity. It's going to develop over time. The same way if you have a look at a bond issue, if there's ever an event, there's all these meeting provisions on what happens, who calls a meeting, what happens, what's the majority, etc. What is the consequences for holders if certain things happen, right? So we need to go through that for these new asset classes. And that's just an ongoing process. That's why I'm more bullish on existing, you know, debt security type instruments and equity securities becoming digitized, right? Yeah. Because there's already the existing technology and rules around that. Now, in terms of your second question around the regulator, you know, the way the regulators are, if you actually look at the FCA's guidance here in the UK, they're going to look at the actual product that you're talking about and say, well, is it a security? In which case, if it's a security, does it have the qualities of a security? We've created a table based on their guide. What are the elements that they're looking for to determine whether a particular asset is a security or not? And then if it is a security, Emmanuel, it's going to be treated in exactly the same way. It doesn't mean that retail can just go and buy it, right? You're going to have the same rules and protections apply to that. Now, you see with the EU sort of strategy that came out 24th of September that Angie mentioned, they're trying to deal with other asset classes that don't fall within current categories of securities and trying to sort of create a framework around it. And, you know, we're 18 to 24 months away from that actually becoming, you know, law, and a lot can happen over the next 2 years. So God knows how it's actually going to really look like by the time it actually becomes legislation. But looking at it, they're starting to talk about rules, for example, for an issuer of digital assets, where it might have some requirements in terms of regulatory capital, what it actually issues, even if it's not a security, something that's going to look like more like a prospectus. That increases barriers for the smaller fintechs that want to come in as well. So there's some advantages to the regulation because you know where you stand, but you've got to be careful you don't end up killing off the innovation, because the small guys, they don't have the resources to do all of that early on. So it's a fine balance, I would say.
So you've really got this world of digital assets, and can we fractionalize assets? And if you can, have you got distribution, or does anybody want to invest in them?
Buy it. What are you buying? Because it sounds great. It sounds great, Anthony. Oh, I'm buying a fractional part of a Lamborghini. Okay. What does that mean? Does that mean I drive it on Saturday? What if I smash it? What are the other fractional holders going to say? Right? So there's a lot of thinking that needs to happen on that. We're not there yet. I'm sure we'll get there.
I think when we get there on the asset side, my wife's actually a professional violinist, and I'm thinking I'm going to fractionalize her violin. I'll sell off a violin, but we keep the violin, and she'll come and play for you occasionally.
Okay.
There's the asset side. But then, as you say, you've got what are securities. So you look at private companies and digital securities in that space, whether it's equity or debt, and you say, well, are these assets people want to invest in? Well, people seem to want to invest in SpaceX, right? And these other fantastic high-growth private companies. And if we can provide an environment where you can get the distribution, then you've got really attractive assets you're bringing to an investor base that maybe don't have that access, right?
100%. That I'm very bullish on that, right? Where we're actually opening the opportunity for investment to things that people don't get access to, right? That's why I'm very excited about the Fin P2P project. Right?
Nice plug there for our big open industry initiative. I can't believe time ran down so fast. I thought we've got ages, and now we've just got a...
By the way, Anthony, I'll send you my Swiss bank account details for making that statement at the end of this call.
Yeah, no comment. But I think if you're listening to the digital securities track, I might be biased, but I think this is the right place to be, right? Because this is where the rubber hits the road in terms of the larger financial services industry making this at scale, right? And enabling distribution to happen globally and help our economies, right?
Absolutely.
Any last words, Emmanuel, Angie?
I think this has been a really excellent panel. I want to thank Angie and Abradat, and obviously yourself, for inviting me, including me. Had a lot of fun. Thank you.
No, likewise. Thanks to all of you. I hope people listening have found it interesting. Don't go away, as they say. I'm sure we're got some fantastic. I'm loving the adverts in the Summit eToro adverts. They're really cool. So we'll take a short break, and then I think we got some interesting further insights into things like digital shares classes and how you can actually get liquidity into some of these large private companies. All right. Thank you for listening, and bye for now.
Thank you.
I got 2 words for you, bestie. eToro Copy Trader. Just find a top investor on eToro and hit copy. From now on, whenever they make a trade, you make the same trade automatically. Neato! eToro.
Next up, we have an exclusive presentation on how digital shares work with Onero's CEO and founder, Ami Ben David.
2, go.
Hi, everyone. My name is Ami Ben David. I'm going to actually continue on the discussion that Anthony just had with Emmanuel and the rest of the team. Very interesting discussion. What I'm going to do is I'm going to take you through at least one of the use cases of digital securities, and we're going to go down deeper into that use case. And that use case is the tokenization and digitization of private companies and shares in private companies. So I'm going to put a presentation on, and I'll take you through it. So again, this is going to be very relevant for CEOs, board members, executives, VCs that have portfolios and so on. And we're going to talk about raising capital for private companies and liquidity for private companies using the digital securities and security token technologies. So Anthony said this before as well. If you're a private company CEO or board member, you're familiar with this market where a public company can be traded online by millions of investors, but you usually see no more than 30 in a typical financing round. It's all done manually. And then when it's done, there's virtually no liquidity or very little liquidity. And we'll talk about the liquidity options that there are there, because there are some companies that are doing liquidity, but there's still a lot of friction in that liquidity. So there's almost nothing that's scalable in between until we actually digitize it. And as Anthony said before, when COVID-19 started, we were looking at what can we do as a financial industry to help private companies out of the crisis. That was something we thought about in the first month of the crisis. And we all talked about private companies having an issue, actually raising based on the old way of doing things, which is very manual, based on personal meetings. And when I used to raise capital for a company, I'd have to get on a plane and travel and meet people and so on. So everything changed. So with COVID-19 changing and creating this new normal where everything goes online, we had to sit and think, what are we going to do now? And that led to the creation of a group of financial institutions that came together to digitize private capital markets and create the digital securities network. In this group, we have over 70 institutions and tech companies that includes big banks, asset managers, exchanges, custodians, and so on. And what they want to do is work together in an open environment to help the private market become digitized and go online. So let's talk about this specific use case of digital securities. So this network that is going to be built is going to connect, let's say in this example, investment banks, asset managers, and exchanges. Each one of these entities, financial institutions, will be able to bring assets, which is companies, into the network. So let's say if you're a CEO, your company will go there, and then they will expose this company and provide access to this company to their effectively hundreds of thousands of investors. So this is a way in which you can move from raising capital from 30 investors, usually be really dependent on the network that you have, which is in many cases local and potentially biased as well, and replace that with a digital network where a private company can raise capital from the entire market of eligible investors. And I want to stress, when I'm going to discuss digital shares in a minute, I'm not going to talk about public companies, and I'm also not going to talk about very early stage companies, because both these areas have solutions. In early stage companies, we have crowdfunding and so on, and public is public. But I'm talking about the companies, private companies in the mid stage, where they're already worth hundreds of millions of dollars. They already have revenues. They're either pre-becoming unicorns or they're unicorns already. And this is the area that we're talking about. So if you're a CEO of such a company and you want to raise a growth round, for example, what you're going to do is, in order to go digital, is there basically are three stages. The first stage is you already have a cap table, and your cap table have, for example, common shares and preferred shares. You keep those in place. What you do is you create a new digital share class in your existing cap table. And in that digital share class, you remove the trading restrictions. So no ROFRs, rights of first refusals, or any other restrictions from moving the transacting in the shares, so that transfer can be done immediately. And you might also make additional changes. For example, you might limit information rights to only above 5%, or things like that will make the digital shares viable for the company, but also for the investors. And then the third stage is that you raise capital on a global digital institutional network, and you raise it with those digital shares. You issue the digital shares, and that's what the investors are getting when they're buying them. So the result is what I would call a private institutional capital raise. We're not talking about public shares here. We're talking about a private capital raise. It's very similar to the way that you raise capital today. You have a cap table, but the only difference is that instead of the cap table being kept on an Excel sheet or being kept on a company service like CARTEIRA or something like that, it is actually being held on a digital cap table and can instantly be updated. What that means is that if somebody makes an investment in your company, then effectively 3 seconds after they make the investment, your digital cap table is updated and you have the money in your account that you can start using immediately. And that's down from effectively weeks that we see in the markets today. So this is the digital shares model. Now, as I said, the digital shares model changes the way that you can raise capital, but not only that, it also affects liquidity. So I'm going to take you through what I would call the elastic life cycle. So in the market today, as we know it, a company can be private, and when it reaches a certain stage, it can either go public or go through an M&A. These are the only options. In the new life cycle, a company can start private, then it can issue digital shares, and those digital shares can trade on an institutional market where all the investors are accredited and so on. So it's an exempt offering. And what you could do as a CEO or as a board, you have the freedom to also allow your existing shareholders to convert to digital. So you can say something like, founders can convert 10% a year, because maybe you don't want all the founders to cash out and run away. So, but you want to give them an incentive to do well. Or you can say the seed investors can recoup their investment, or whatever other method that you want to do, you have the option to do. Then when the company is ready and you can actually go into the next stage, you can either go full digital and stay within the non-public world. It's less expensive, you have to provide less information and so on, and you still have some liquidity in the institutional market, or you can just go to the public or M&A standard models. So, I'll go back again and explain. So first you created a digital share class in your existing cap table, removed all the trade restriction, put it on a network that is run by financial institutions, and reach their investors through that network to create your capital raises. And then you're able to go in and create elasticity in your liquidity as well. I want to switch quickly to another screen and show you a short demonstration of how it actually works, because sometimes we talk about big things and big concepts and turning those manual processes into instant digital, but I want to show how instant it really is. So let me quickly switch you to a quick demo. And this is an example of in this case, we're talking about a company, and the company is called Eaglebase. The owner of Eaglebase can have information about the assets that they have, and in this case, they have a cap table. And in their cap table, you can see that there are two owners. One owns 46% and one owns 53%. And these are basically the owners of this company, Eaglebase. This cap table, this digital cap tables, is live. What is the meaning of live? It means that if one of those investors, like this is in the screen of an investor called Investor Fund, one investor goes inside to their banks or their broker or any screen of a financial institution that provide to their clients, and they can see their assets there. I'm not sure you're seeing my screen. I'm being told that you're not seeing my screen. Let me go back to the presentation. I was presenting, I was sure that everybody's seeing my screen, but apparently not. So what I was actually showing was how easy it is and how simple it is for an investor to view the offering of private companies, to make a decision, to click invest, and then it goes through automated AI system that checks the regulation compliance of that offering. And if everything goes according to plan, 3 seconds later, they're on the digital cap table. If the company is looking at the digital cap table, they will see that this client, this investor has now joined their cap table within 3 seconds. And that's very different from the way that private companies raise capital today. So I will go through the advantages of this and what we're trying to achieve. And I think some of it Anthony covered as well, but I will talk about it in the context of private companies. So as a private companies, if your due diligence was done separately with each investors across dozens of meetings and so on, in a newer environment, you will have one standardized data that you will share with investors all over the world. You can do Zoom roadshows, you can have structured, searchable data, and it's all digital. If the investor reach was based on meeting 30 or 50 investors based on your personal connections and the connections of your board, and a lot of cold calls and so on that get ignored, and CEOs know what I'm talking about. This is a way to get an investor reach that on a global network of effectively hundreds of thousands of institutional investors. If the legal or regulatory would require you to work with lawyers on every transaction, on every clause, with every investor, we will switch to a model where you publish the terms in advance and everybody either sign into them or not, and all the regulatory cover is done completely automatically. So this is all done through automated AI, simplified, unified, and a lot simpler to do. In terms of management, cap tables, we all know the Excel-based cap table, or even in automated cap tables, you still have to, when you do the sale of shares, there's a lot of management and a lot of work, and the life cycle is hard to manage. This is all digital and online dashboards, live cap table, completely new world. When we're talking about liquidity, we switch from a world where you have near zero liquidity to a world where you can have liquidity in a global institutional market. Now, to be clear, this is not going to be like Tesla type of liquidity. It's going to be more like SpaceX type of liquidity, meaning the company is not going to turn over hundreds of percentages every year, the entire cap table turning and changing hands. But the current scenario is zero or near zero, 1%. If you can get to 10% of liquidity, it means that founders can sell. It means that investors can sell their assets. It means that the whole market can be different. We can talk about it in a few minutes in our panel. And the last point is the distribution. Until now, most companies, when they do private sale, distribute themselves. The financial industry does not know how to help them. For the financial industry working with a billion is working with the same cost as working with $100 million or a $10 million raise. So why would they work with a $10 million raise? But when you automate everything, new business model emerge that actually enable the financial ecosystem to work with the company and help them. So I think that covers my presentation, and we would go next to the panel. Thank you very much.
One donut stand, 5 hidden cameras, 2 actors, 100% happiness.
Fresh made donuts today.
Or is it?
Fancy donut?
Gonna have jam, please.
Cream donut, please.
What the hell?
What the fuck?
What just happened?
Oh, hell no.
Did you just bite that?
You won't even notice, it's very small.
Oh, it's a new one. You don't have to bite.
That's my commission.
But it's out of my donut.
I was expecting 100% of a donut. What the fuck are you doing?
Just how the world works.
Shut the fuck up, I don't want that. That's disgusting. No way. Take this back.
If I pay for something, I should get the full thing.
We have to take a bit of commission, otherwise...
See, she's walked away.
Don't let commissions bite into your portfolio. Join eToro and invest in 100% stocks with 0% commission.
You've got a little commission. Right there.
eToro. Join now.
Let me guess. You're too busy to watch this ad. Just like you were too busy to invest in Bitcoin or Ethereum. Oh, who's a Gucci boo-boo? Who's a Gucci boo-boo? You're a Gucci boo-boo. You think trading crypto is hard? How hard is it to open eToro, pick a coin, and hit trade? Now, maybe you're thinking, but I'm just a food blogger. I can't do this trading stuff on my own. Well, I got news for you, pal. With eToro's social trading, you don't have to. This is called a news feed. It's like your social media feed if your social media feed had things that mattered. And if you got any questions, just ask them. Observe. Can I pay my babysitter with Bitcoin? But sir, my brain can't handle more than 140 characters. Is there some way you could make things even easier for me? Why, yes, I can. With Copy Trader. Just find a top investor on eToro. How about someone with piercing blue eyes and a voice so husky you could pull a sled and hit copy? You. From now on, whenever they make a trade, you make the same trade automatically. Neato! I just made a trade automatically! I'm so proud of you, bestie. So join eToro and start trading the world's top markets. I got a plane to catch. Got it. eToro.
David with Nisa Amalis of Grasshopper Capital, Gilad Amir of Pollen Street Capital, Amir Blackman of Axiom Space, Greg of SharePost, and Avichal Garag of Electric Capital.
2, go.
Hi everyone, we're back, and we have a great panel here to discuss the how security tokens and digital shares are actually going to affect the market, specifically private market, private and startup companies raising capital. And we have a great panel here to discuss exactly the implications of this new innovation, including 2 VCs, 1 expert from the private equity side, and 1 company as well, representative of 1 company with a lot of experience in raising capital. To go through the implications of what we're going to see. So let's start with an introduction, a round of introduction. Please, every one of you go through, what you do and your relevancy to this market and digital securities in general. Let's start over with Avichal. Go ahead.
Hey, everybody. Avichal, I'm a founder and a partner at Electric Capital. We are a crypto-focused investment firm. I've spent most of my career as an entrepreneur, actually. I started and sold 2 companies, also a very active investor inside and outside of crypto in early stage primarily, but have done a fair bit of late stage investing in companies like Boom Supersonic, actually, which just today announced the fastest civilian airplane ever built. So lots of experience with shares and starting companies outside of crypto as well.
Thank you, Avichal. Let's move over to Amir from Axiom.
Hey, Ami, good to see you all. Thanks for having me on the panel. So my name is Amir Blackman. I'm the Chief Business Officer at Axiom Space. My role there primarily is centered on fundraising and on financial planning for the company. And so Axiom is doing 2 things. First of all, we send missions to the International Space Station today. We're the only private company who does that right now. And we're also building the commercial space station that will replace the International Space Station at around 2028. So it's a large-scale program, and to that end, I've been talking with Ami and others in the digital securities field to see what the options are for digital securities to serve as a capital source for our company and as a potential source of liquidity.
Okay, let's move on to Nisa.
Hi, everyone. Thanks for having me. Nisa Amoils, partner with Grasshopper Capital, been in venture capital for 10 years, and also am a corporate and securities lawyer, have been investing in digital past 3 years. And Ami and I are part of GDF committee. Together, we are trying to make this happen. So very excited to talk about it.
Thank you. And Gilad.
Hi, everyone. I'm Gilad Amir. I'm the digital operating partner at Pollen Street Capital. Pollen Street Capital is a private equity fund based in London that specializes in financial services, financial and business services. We have slightly over £3 billion of assets under management, and our portfolio spans across all the subsectors from banks, insurance, payments, FX, wealth management, and all the enabling technologies around this. And I've been watching this space closely as one of the future enablers for PE funds.
Okay. Hi. So thank you for coming, all of you. So what I want to do is I wanted to break this conversation almost to two parts. One part is about raising capital for private company and comparing the new digital model of a digital share that I just described before to the way that it's done today. The cap tables, the Excel sheets, or similar to Excel sheets, and the one-to-one meetings, the kind of small scale versus the ability to go to a much larger institutional space. So that's the capital raise. And the second part of the conversation is about the potential for liquidity. Liquidity for private companies, is it good? Is it bad? Is it required? And so on. So why don't we start with the way that capital is being raised? So I will start with you, Avichal, again. You come from you're representing the VC industry here. And the VC industry is known for investing in companies that disrupt other markets, I'll put it this way. Do you think that digital shares are actually going to disrupt the VC market? Do you think that that's something that's in our cards, or do you think it's going to be a more of a small upgrade? Will VCs continue to dominate the market, or do you, and I'm talking not about early stage, I'm talking about mid stage and growth, or do you think that once it is open to a bigger audience of investors, then it will be much more, much wider? What is your view on this?
Yeah, it's a good question. I think it is extremely disruptive, but it depends on who you are. So, if you're a mid-stage or growth stage VC, and you don't have a brand, you don't have deep expertise in a particular area, the primary value that you bring to a company, I think, is capital. And in a world filled and awash with capital, I think as these platforms go digital, you're undifferentiated. And so if you're not in percent of VCs, this is extremely disruptive to your business. And from the entrepreneur's perspective, why would you take money from somebody who's sort of the meat VC if you can get it more easily on a platform? You push a button and capital shows up and they stay out of your way. And so it's disruptive to them. I think if you're in the top 10% of VCs, what does the VC firm really bring? They bring capital, obviously, but they also bring expertise and depth of, there's some value out there. And they often bring governance and some help in actually thinking about how to run the company. And so these platforms, I think, start to unbundle that a little bit. And so, I think for the top 10% of VCs, it'll stay bundled. But I think you start to get some really interesting properties, such as on these platforms, could you have experts in certain areas pair up with people that give you capital? And now you start to deconstruct what a VC might be. And so could a growth stage round be constructed by going to a platform that brings a lot of capital to the table? And at the same time, there's experts that come in and bring a little bit of capital and maybe get some leverage on their capital in exchange for offering expertise to the company. And so I think you start seeing new models emerge on top of these platforms. And the people that really get disrupted are sort of the bottom 80% of VCs. I think the top 10 to 20% actually have a great business for all sorts of other reasons.
Yes, no, I totally agree. And I think that a lot of people, even in a company, they will want somebody to follow, and they will need the expertise there. But as you're saying, for the rest of the VCs that don't bring differentiation, it's about access. Amir, from your side as a company raising capital, exactly in that space that we're talking about in the kind of growth stage, what is your experience there? Do you see the value in something like that, and how will that change your strategy in raising capital?
Sure. So, we're trying to weigh out the risks and rewards of working to raise capital through a digital security. So we look at some of the pros related to liquidity in terms of, from the investor side, it shortens the investment horizon. It attracts more capital. The con is if that investment horizon is too short, we're going to attract the type of investors that want to come in and then quickly sell and go out, and that's really not who we want. We want investors who want to come in and then want to reinvest. So that could be an issue. Although that is kind of a double-edged sword, because we might, through that mechanism, get some of those less desirable investors up front, and that helps the company get along to the point where we can attract those long-term investors that we're more interested in. So it can play a few ways in that aspect. Some other thoughts on that is it can generate a liquidity premium, so we might be able to raise at a higher valuation. We instantly have a secondary market, so that's good for early employees and early investors. Another thing that's related to that could be a danger is that what this creates is a publicly known arm's length transaction that could create a down round, even if the company is doing well, just because there's something going on in market sentiment. So we have to be aware of how much of the company's total equity do we float to the digital security, and so that's something that we need to consider. Another thing from a founder's perspective is digital securities are new. So it requires significant diligence from us and costs with our legal team to understand how the digital security works, what are the potential pitfalls. They're not broadly used yet, so we might become expert on this, but the next issuer is going to want to get to that expertise in understanding how this works. So I think it's still, at this point, hard to know what the investor base is for digital securities and what the liquidity premium will really turn out to be. So it's actually a little bit hard to do that weighing out. So for us, we're still in the position where we're very excited about digital securities. We know exactly what it offers, but we do want to answer those questions, which we'll ultimately do by going out and talking with the digital securities investors there to find out what the thirst is.
Yes, and I think this is one of the reasons where the project that Anthony and myself spoke about earlier is bringing together financial institutions, because we believe that it is very hard to sell to institutional investors to come and invest in a, maybe on a network that they don't know and they don't trust. But if they just get the investment from their known bank, known exchange, the people that they work with to get the public securities anyway, and they're trusted and they know that they wouldn't get into something that's not regulated, and the big CSDs aren't involved and so on, that would just turn it into a security. You start with a security, you move to digital securities, and in the end, it will just be securities again, only they will be digital. And that's, I think, is to your last point. And I want to move on to Nisa, and something that Avichal said earlier was that maybe there's 10% VCs that will gain from this, but a lot of the smaller VC will be less advantageous. It will be less advantageous for them. But maybe I think something that you're doing, is there a room for new type of VCs that actually have expertise in this new world of digital securities and actually focus on that type of specific companies and know how to offer them specific advantages as well? Because I know that's something that you've been doing over the last few years.
Yeah, I think that we're talking about different types of VCs, but what we really should be talking about is later stage. And this really affects more of maybe private equity, and it's disrupting the value chain in that the company may opt to use a banker or a broker dealer. You have 9,000 US VC-backed companies between the sizes of 100 million and 1 billion that can't go public right now. Not even including can't justify their 7% fees on an IPO right now if they don't get the pop, which led to the whole SPAC creation and a symptom of the larger disease. So you're really talking about liquidity. You're talking about potentially creating a digital shares class that has fewer investor protections, because you would strip out things like veto rights. You'd remove some of the trading restrictions to allow for liquidity. And that's good because it removes some friction. It automates the process. It might standardize due diligence where you have like a PPM equivalent form template, and that eliminates some of the legal fees as well. So I think that there's definitely room to play with this digital share asset class, particularly for investors that do have value add that go beyond governance, whether, like in my case, a legal background that might be helpful. So I do think that there's room in the market to play with this.
Thank you.
If you'll allow me, I just want to ask Nisa on that. Do you think that those investor rights that are stripped away are more important or less important to investors than the liquidity premium?
I think that they are probably, as long as pro rata rights are preserved, I think liquidity is something that people are looking for, and that's why you've started to see funds with shorter and shorter lockup periods, particularly in this sector. So I think that having that, getting away from the 7 to 10 year horizon with some extensions is a good thing.
Yeah.
Thanks.
And we talked about the VC world, but obviously a lot of the companies in this size and the companies that would need this type of access to capital are in the private equity space. So Gilad, from your private equity viewpoint, how do you see digital securities? How do you see them influencing your market? Are they going to be as disruptive at your market as they are to potentially other markets as well?
Yeah, well, it will take some time until it will get on the radar of PEs, okay, and we become mainstream. But I think that, so I totally agree with Avichai. I think that, as PE firms traditionally are much more involved in the value creation process and work more closely with the companies. So I think that there will be less impact on PEs. I partly agree with Nisa about. So I think that there will definitely be an impact on the entire industry of introducers, investment bankers, brokers that will need to reinvent themselves in this new world. But I see very limited impact on PEs. Maybe if the market will be open to non-accredited investors, so that could change the dynamic over time in the long run. And then PEs and VCs, but mainly PEs will act like wealth managers in a way, but it will take time. I don't see any real impact in the short term.
Okay, but do you think that PEs are going to see, do you have, or not specifically, but the PEs that do you have in your portfolio companies that you think would want to digitize part of their cap table, not necessarily just for big raises, but you think that brings value to PE-owned companies compared to the alternative of staying private versus going public?
Definitely yes. I think that again, it depends on the terms, because I think that one of the risks is that you don't know who you may end up with as a partner in the business, right? So that's one of the risks that you need to hedge, right? But I think that in general, this concept of having a new market with all the advantages of the public market, but without the hassle, is massive, right? So by definition, it will have real value in some cases. And I think that the PE-backed companies would probably be the first candidate actually to use this at scale.
Mm-hmm. Yeah.
I mean, I think one thing you just said is really interesting is like a common pattern you see in a lot of markets, which is you take something that was very discrete and you make it continuous. And
that's
like
the point about technology, right?
Yeah, and it's a powerful disruptor, I think. I mean, if you look at in the early stage, I'm sure all of the listeners here spend all of their time on VC Twitter like I do. But if you spend time in VC Twitter on the early stage side, there's a lot of discussion right now around angel list rolling funds, which are sort of a digitization of seed stage funds. And one of the breakthroughs there too is the ability to make it a continuous fund. You can sort of do this rolling fund where people can subscribe every month. And there's a lot of discussion back and forth about what are the consequences. And I think this is very similar, as you see this pattern all the time, is when you take something, to your point, that used to be either public or private, and they exist in two different spheres, and then you break that down and it's like it's no longer discrete. Now there's a continuity in between. What are the consequences? And in general, I think when you're talking about capital markets, what it does is you realize that there's actually a lot of capital sitting on the sidelines that fits into neither of these worlds. And all of a sudden you activate all of that capital. And so generally, it's a good thing to bring all that capital to work. It's good for founders. It's good for employees. It's good for companies. I think it's a little bit TBD who that capital will be and what form it'll take and how it'll sort of coalesce. But I think your observation is a really good one, that sort of moving from a discrete world to a continuous world is going to be pretty interesting at the very least.
I would just add, because I have a rolling fund, that I think the angel is disrupting that market, which is really disrupting on the earlier stage, is eliminating some of the barriers to investing. And I think that's exactly what we're talking about here, is that we're trying to do that, but just for later stage companies. And so I think there will be these continuous disruptions along the value chain of capital formation. And we've seen that also, in DeFi with fair launches and, if we even want to go into like what ICOs were, but we don't have to talk about that.
Yeah, I think that this is a kind of an interesting segue, because you're talking about the ICO. Digital security tokens started with going on public blockchains and going to retail investors. And actually a lot of the assets that came on there were not suitable for retail investors. They were not even allowed to invest because they're not accredited and they're not financial institutions. And a lot of those trillions of dollars that sit in private market can only be accessed by the institutional market. And for that reason, a lot of the work that we've been doing over the last few years was to bring the financial institution market to help in that, and to bring the assets into the market, to underwrite them in a way, to bring their institution investor and give them the confidence that the assets are real and they're actually tested, so these are not scams and so on. And it's interesting, I think, to see the market, how the market will behave to having those intermediaries in the middle, because the whole kind of crypto model was remove the intermediary. And here we're saying these have a lot of value in the process in creating a market. Some of them are banks, some of them are exchanges, some of them are applications and so on. So that will be interesting to see, I think, how the market will react to working through these entities. And I don't know if there's this is one of those markets when a startup like CARTEIRA can come and sweep the market, because it's such a huge market and there's so many investors out there that are going through their financial institutions and they trust them and they have whole funds rolling through them and so on. So that's an interesting thing to look at. But we don't have a financial institution here on the panel, so that was in the previous panel. I want to move on to the next kind of subject. We talked about raising capital, but let's talk about liquidity. What I heard, and I want to start with the VCs again, and then hear Amir from the company side as well. When I spoke to companies about digital securities, the founders would say this: "I love it. Now, how do I sell it to my VCs?" Okay, because the founders want to have 3 or 4 years. Liquidity could change their life altogether. They might be sitting on shares worth a lot of money with no access to them. And founders are, yes, I want this, give me this yesterday, but they're afraid of their VCs. Why do you think VCs might object, and what do you think might convince the VCs to enable this type of liquidity?
I think that if you had the founders convert a certain percentage every year into liquidity, that you might not get such objections from the VCs. From their point of view, though, they want to make sure that the founders are incented still and that they still retain a large portion of the equity so that they're incented to do a good job in the company. But I think there are creative ways you can come up with that, a certain percentage going liquid, or put some controls around it that would be attractive, a win-win for everybody.
Yeah, agreed. I think kind of two thoughts on this. One, I think he says exactly right. There's this element of incentive alignment, which is really important in the long term. And actually, I think the best VCs are pro founders taking a little bit of money off the table. And it's because it really does change a founder's psychology. When you go from having $0 in the bank to having just enough that you're not worried about paying your bills and feeding your family, and if somebody has a health issue, like, can you take care of it, that kind of stuff. I think if that's out of the back of your head, you're actually a better founder. You can actually focus on making the company big. And I've seen that, and that number is different for everybody, but we're actually very, very big fans of, like, at a Series B, somebody taking a little bit off and de-risking if that makes them feel better. And then actually that can lead to much bigger outcomes because now I think that the challenge is you have to pair that to, I think Nisa's point, with if it's too much that's taken off, it can be disincentivizing. And actually, one of the hardest things I think any investor will tell you is just not selling, right? Like the temptation when a company goes up 10x is to sell. And actually, like, real wealth for founders and for investors is made when a thing 1000x's, right? As an early stage investor, or 100x's. But it's actually the hardest thing is to not sell between 10 and 100x, or any crypto investor will tell you that, right? Like, crypto is littered with stories of people that bought Bitcoin at 300 and then sold at 3,000, or, and they're like, oh man, I could have held on 20K or 100K or whatever. And so actually in a weird way, like, the liquidity has to be balanced with actually this thing that it does, like illiquidity does, which is it forces discipline. Because if you can't sell, you actually get to often, if the company's going well, you realize significantly more upside. But I think there's a healthy balance in there. To your point earlier, it doesn't have to be binary. I think actually, like, a little bit of liquidity can go a long way.
I think I would turn that over to Amir and Gilad to answer, because there's one interesting thing that I saw, what you're describing is this, is really from the VC side, because as a VC, the ideal is to do the 1000x, to get the companies that become the super unicorns, and then, but actually not all companies get there. And there's a lot of companies that will never get there, and they're still very, very good companies, and they make a lot of money, and they're not going to exit as a public company. Or in the PE world, Gilad, what is the importance of liquidity for founders and early investors, seed investors, and so on, as companies stay private much longer and so on? Do you see this as an important element, as a valuable element? Do you see that as a problem in the current scenario?
Again, it depends on at which stage of the value creation. If we are just right after the investment, or pre or close to the exit point. So obviously my answer would change, but I think that in general, this concept of, again, raising money faster, much faster than any other alternative, the fraction of the cost and headache and restriction that you would have otherwise, and whether it be debt on equity. So obviously, it's a valid and very interesting option for businesses, and with all the liquidity that we see in the market, it's still a very interesting, I think, option and product you have in the market. With that, I think that, again, the lack of control about where their shares may end up with, and who will be the future shareholders, coupled with again, I would just mention smart contract in the context of the governance and how it work in practice. The less forgiving nature of smart contracts, okay, can in some cases put them in suboptimal positions, right? Because as a private equity investor, or even as banks, we have enough flexibility to work with the companies when things go off track, right? And that wouldn't be the case, I think, when they issue digital shares. So there are some obviously pros and cons, but the answer is definitely yes. Okay, I think that and to be honest, I think it's inevitable, really.
Okay, and Amir, from your side as a founder, and when we're talking about liquidity and this tension between investors and founders and early investors as well, not just founders. I mean, there is an argument to say that seed investors are suffering the most from the status of private companies going on and on and on much longer than they used to be, and they're being squeezed over time. And having a seed investor also being able to exit on the 10x, as you called it, Avichal, earlier, and then go back and reinvest makes a lot of sense for these investors. But Amir, for you as a founder, what does liquidity mean in terms of kind of structure and your balance with your investors?
Yeah, so all the good answers have been taken already. So I'll add a little modest addition here. One is, before looking at the individual company on the macro level, if you create an environment where enough seed investors are able to make some exits, then I think you're adding overall investment velocity in general, right? So, and that's a good thing for everybody, because more startups get funded because you have happy seed investors. So that's one thing to consider in terms of the macro effect this could have. I think the answer to the question regarding how much founders should be able to sell and when they should be able to sell, it's exactly the balance of what Nisa and Avichal were saying, where you got to keep the incentives aligned. It's very, very important. And the balance is not just how much cash does the individual who's selling shares put in their pocket, but what percentage of their overall holding in the company does that represent? Is there still a ton of upside there that will keep them excited to work? And I agree with Avichal entirely that a relaxed investor is often a better investor, so long as that they're not so relaxed that they're out on a yacht. And so, so the last thing that I'll just add, which what I said would be my modest addition here, is that from the VC standpoint, if they can get past the concern of not knowing who their partners will be through the issuance of a digital security, is that if the investment is done early on, like pre-Series C or like up to Series C, you're broadening the investor pool within a company that could potentially reduce funding risk in future rounds, if those are the types of investors who, and this is why I'm saying it has to happen early on. If an investor comes in on a digital security at, a post-seed or a Series A, there's probably a good deal of likelihood they want to reinvest if they believe in the company to the B and C. Once the company has passed the C round, that type of investor won't be able to afford the later investments. But on the earlier front, on the Series A to C, I think there's an opportunity for that broader investor pool to reduce future funding risk.
Yes, go ahead.
Sorry, I just wanted to build on Amir. You just dropped a knowledge bomb, which is really, really good in your first point, which I don't think we've talked about. So there's kind of, there's the entrepreneur perspective and there's the VC perspective. We didn't really talk about the ecosystem, but that first point you made is a really, really good one, which is, part of what makes Silicon Valley special and work has been the small exits. And so what you get is this recycling of capital through founders and through angel investors that facilitates that ecosystem. And that works in some other small parts of the world, but that dynamic actually doesn't exist in most of the world today. And it really hampers the ability for companies to even get started. Because if your angel investors and your seed investors are looking at it as a 12-year commitment or a 15-year commitment, and they never get liquidity on 90% of the things that they invest in, there's just not enough capital circulating to make the whole thing work. And so actually by unlocking capital in the later stages for earlier investors and getting that capital to recycle, what you're really doing is allowing that dynamic that, one of the important dynamics behind Silicon Valley to actually work in a lot of other places now, and bootstrap, more and more seed ecosystems. So actually, I think that first point around capital recycling is a really, really good one. Yes. And a very important one for ecosystems.
I agree, Avichal. I would actually take your point and try to even enlarge it even more, because you mentioned the value, and I think that potentially one of the things that digital securities can do is they can basically remove some of the biases of, if you take the same company that's born in the Valley and the same company is born in Prague, right? It's going to have, and they're doing exactly the same thing in a global world where, all the services are SaaS based and so on. Those two companies will get different valuations, different ability to raise, different access to the top investors. And that's why that company might not actually happen. It may be a better company, it may be better better founders and so on. So there's an element of, in today's market, when you raise capital, it is a lot about who who you're born. And we all know as founders, if you send a cold if I send a cold email to a fund and they don't know me or they don't know anybody that knows me, the chances are I will go to a junior and I'll never see a partner. So that's the reality of things. So in a digital world, an automated kind of digital world where the PPM, as Nisa said, is open, I think that there's definitely a way to remove a lot of the biases that are almost entrenched in the current environment and open it up to more companies from more places to more investors. I don't know, Nisa, what do you think about that? Kind of.
I agree completely. I think that democratization of access to capital is one of the ethos of the crypto and blockchain sector, and especially in digital shares. And I think that's what you're seeing with the rolling funds, is removing those biases as well. And I think that digital shares can really help to bring great projects from all over the world by any type of founder and by any type of funder. And so that's something that's really long overdue. I think it was Chamath at Social Capital a while ago who was using AI to decide, what investments they were going to make, and their makeup looked a lot different than a typical fund. So I think pattern matching and bias is a very real issue, and access this can solve.
Yes, that's why I raised it. And I think if you put together all of these elements, the access, the democratization of the access on both sides. When I mentioned before that a founder sees 30 to 50 investors, it's actually the other way around as well. Only 50 to 30 investors see the company, and it might be a great company, and other investors don't have access to it. So it goes both ways. If you put that and you layer on top of that the ability to add more money into the ecosystem by recycling the money, as you mentioned before, Amir, I think there could be consequences of digital shares that it's very hard to foresee at this stage for us what it means. And I think that's what part of happens to a market when it goes through a transformation like that. You can't really predict what will happen on the other side. You can only kind of guess who will be the winners and the losers at the end of this process. But I still think that, coming back to Avichal's original first message was that there's a lot of value in identifying the right companies, in really knowing how to help them and how to promote them. That's not going to go away by digitization. Okay, that's definitely going to stay there. And Gilad, from your side as well, I think even more private equity work even closer with the companies, right? So for you guys, it's definitely something that you will continue to lead in this environment.
Although you could argue that we could automate and develop our own version of robo-advice, if we will face like a 20x, 200x, more volume with the deal flow we need to process and work with. So you could argue that, our model would look more similar to stockbrokers and wealth manager than the way we do things today. But yes, it won't go away. I agree.
So we're about to end our time. So maybe a couple of ending sentences for each one of you about what you see in digital shares, digital securities, future, and whether you're going to be involved yourself in that market over the next year. Do you think, or will it take longer than that for you to get involved? We'll do a quick round. So Avichal, why don't we start with you?
So to your first question, yes, I think we will be involved. I think, I actually think my long-term vision, or what I would love to see happen, is everything from company inception all the way to being public just moves to better infrastructure. And so I think a world where literally somebody sitting anywhere in the world, they start a company, hiring people is easy. There are marketplaces you can go to, you can hire your friends, paying them is an API call, doesn't matter where they live in the world. The money just shows up in their bank account, and actually probably moves over crypto rails. Every subsequent round can happen by people all over the world who have different areas of expertise, and you can find people who have different kinds of expertise that you need. And the entire life cycle of running the company basically moves to this kind of infrastructure, because if you think about all of these discrete things that companies have to do from inception to IPO, I don't know, there's probably some number that somebody should calculate, but you probably kill like 10,000 trees just in like the amount of paperwork that you end up doing, right? Or like the number of hours that gets spent doing paperwork and signing documents, and it's just so inefficient. And it should all just be digital. And so I think this is one piece of it, but I actually think the whole life cycle of the companies just gets digitized, and we'll all be much better off for it.
Thank you. Amir, your summary?
So on me personally, because we've been talking for a while about this. This is something that we're interested in as an issuer, and for all of the pros that I mentioned earlier. I just want to add another note on kind of big picture effects. I think at the outset that this is going to play to the benefit of issuers, especially at the beginning, because we're a rare breed. So there are not a lot of us who are there who are excited about this. We've spent the last couple of years getting in the know. I also think it's going to play to the benefit of early movies on the institutional side, because this is going to lower their transaction costs. They can provide a more cost-efficient product to their customers. So I think institutionals are going to benefit from this, the ones that run on this. And I think if digital shares do become ubiquitous, we'll, at some point reach an equilibrium again. But I think we're in a very, very interesting time right now that's probably going to not last longer than 5 years. The last thing I think, looking at this from an issuer side, that I'm actually excited about is that I think digital securities may become a real competitor for VC's deal flow. And I think that's something that any issuer would be excited about, that there's a new class of investor here to be captured.
Okay, so I'm being asked to wrap up. I will just say one more thing. If any companies watching us or VC that have a portfolio that want to think about digitizing their assets, the industry group that I was talking about is in a pilot, and we're going to, coming into the Q1, we're going to start doing real assets on this network of, as I said, financial institutions and so on. So you can approach me directly and talk about it. You can all find me on LinkedIn or Twitter, and I'm quite available. I was asked to wrap up, so maybe Nisa, one more sentence from you, and then we'll one more sentence from Gilad, and we'll wrap up the panel. Thank you.
I'm already involved. Transparency
are digital tokens of value that can be transferred to anyone around the world without relying on a third party like a bank or a credit card company. eToro.
More institutional investors how the regulation, the public infrastructure, and the liquidity and distribution will develop. Okay, so this will be the three enablers, I think.
Up next, we have a deep dive into the world of tokenization, escrow services, and smart contracts with Wendy O of Beyond Associates, Natalia Kariava of Bloqueie, Moshin Masoud of Tokenism, Blake Richmond of Vertalo, and Michael Flight of Liberty Real Estate Fund.
Go.
Everyone, Wendy O here. First and foremost, before we get started, shout out to Los Angeles Blockchain Summit for having me back to moderate a panel. This particular topic, I'm extremely excited to learn from these amazing experts because I'm currently selling my house in Los Angeles County. So it's going to be fun to kind of hear their expertise on things. So today we're going to be talking about tokenization, escrow services, and smart contracts. And as most of you guys know, Ethereum, smart contracts, and tokenization of various hard assets that are tangible and intangible is currently booming. We're seeing this with the NFT market, but NFTs are a little bit different than real estate, whether it be commercial real estate or residential real estate. So we're going to go ahead and take this time to go ahead and talk about tokenization with these real estate folks. So does everybody want to go ahead and introduce themselves? Tell us a little bit about what you guys do, your name. Mozan, do you want to go ahead and go first?
Sure. So my name is Mohsen. I'm the founder for Tokenism. Tokenism is a platform for fractionalized sales of commercial real estate assets, which enables single direct investment with as low as $1,000. We're actually going live with the platform on October 12th. So 4 more days to go.
Congratulations. Michael.
Hi, I'm Michael Flight. I'm CEO of Liberty Real Estate Fund. We are launching the world's first lease security token fund, and we expect to be launching that at the end of October. Our initial raise is going to be $30 million, and we invest in super safe, super stable, triple net commercial properties throughout the United States.
Blake, what about you?
I'm VP of Finance at Vertalo. We're a data management platform for tokenized assets, and we have a team that is dedicated to deploying this technology in the real estate space. I'm also a partner at Novo Block Capital and a trading advisor with Sarson Funds.
Nice. Natalia, what about you?
Hi, everyone. My venture Propi is one of the first companies in the world to finally be able to automate the real estate transaction with smart contracts. After 10 years of being a real estate developer myself, combined with 4 years of property development, we've got the National Association of Realtors to invest in our mission. Now, recently, Team Draper, and many agents, realtors in the United States, consumers are utilizing property and blockchain on end of our product. In 2017, we had a token sale, and this allowed us to build a robust, hard to replicate product. And Wendy, I'd be happy to help you to sell your house.
Awesome. Well, I've got an agent now, but we will be interested in buying soon. We're anticipating the market to correct a bit, so we're going to hold on to our capital, and hopefully I can utilize some of your guys' services, because everybody is so diverse and unique here. So my first question, when we're talking about being diverse, how can someone, your average Joe, benefit from real estate and blockchain from your guys' professional experience, or is it really just for the big dogs, people with a lot of money? If Mozian wants to go first.
Sure. So I can start with that. Our biggest USP is the fact that we're reducing the minimum investment in commercial real estate down to $1,000. Right now, real estate is only accessible to, as you put it, the big dogs out there, people with the big money, and it's not accessible to your average Joe. Anyone who wants to invest needs to have either a larger saving, or needs to syndicate, or can get some real estate exposure with limited returns through investing into REITs or funds, but that truly inhibits their liquidity aspect on that investment. And it's an investment which you're stuck with for a longer period of time, whether it's 3, 5, or 7 years or so. Tokenization, at least with tokenism, how that works is you're able to invest with a minimum of $1,000. You're able to trade those security tokens freely after the initial hold period, as prescribed by the SEC, and it gives you an alternative investment class within real estate at very low minimums. So opens up the market to the entire world, truly democratizing real estate investment.
It sounds like it's really leveling the playing field out.
Indeed, that's the idea, right? So level out the playing field for everyone. Everyone should have the same opportunities, and not just the top 1%.
I agree. What about you, Michael?
My background was in institutional real estate. So we were used to dealing with insurance companies, hedge funds, private equity funds. And so one of the first thing that really drew me, especially when I was talking to all my friends that were doing cryptocurrency, is like, well, number one, I went to a public school, and so I never learned math very well. So when they started talking about hash, I said, no, I avoided that in high school, okay? So not sure what a hash function is. But anyway, I really saw it's like, this is like a worldwide phenomenon, not just, our typical investments that we had done in the past with shopping centers. It was friends and family. It was bringing in a hedge fund, or, a pension fund or an insurance company, and come alongside. And we looked at the security tokens and said, this is a worldwide phenomenon. Anybody in the world with the amount of money to invest can invest in something. And we think that, especially with the hard assets, including real estate, ours is cash flowing. So my partners hate this, but we call it crypto with cash flow. So, I'm just so excited about this, opportunity to bring a worldwide, there's all this investor money sloshing around.
What about you, Blake?
Yeah, I'd echo what Mohsen said in terms of fractional investments and fractionalizing these properties for smaller bite sizes. I think that there's a lot you can do just beyond enabling these smaller, where you take pieces of different fractionalized investments and create unique risk instruments or unique return profile pools. And then also the cost of capital. Providing these traditional financial services in a decentralized manner, leveraging some of the DeFi money market protocols, lowering cost of capital for the user, and creating instant programmable credit availability without having to have 7 years of the W-2. I think that is that's some of the really kind of off-piste downstream effects from using this technology with real estate.
Yeah, when you're talking about having to provide your W-2 and whatnot, having to provide your income and different revenue streams can be a little bit challenging for some people, especially some people I know, at least in Los Angeles County, that do have to work under the table for extra cash, kind of to pay their bills and whatnot. And they're eligible for FHA loans or to invest in commercial real estate. So I feel like that levels the playing field out, and it makes it easier for your average person to invest and, you know, to increase their wealth and then pass that generational wealth down to their kids. And Natalia, what about you and your company?
My company is tokenizing the process, the real estate purchase and selling of a home. And for example, Wendy, in your case, you would introduce us to your agent, and then we would help you and your agent to close a deal entirely online through Propy. You would see all the traditional processes and